Suppose you want to invest but don't know where to start. Well, today's your lucky day because in this video, we will be talking about 7 investments that will make you a lot of money by 2023. But before that, let's take a bird's eye view of what the world is like in the stock market and how investors earn from them. Actually, there are many ways for investors to make money on the stock market. One way is to buy shares of growth stocks, which are shares of companies that are expected to grow their profits or revenue at a faster rate than average. Companies that do this for a long time can get higher prices for their shares, which gives their shareholders a big return. Growth investors usually put their money into growth stocks, which are shares of young or small companies whose profits are expected to grow faster than the industry sector or the economy as a whole. When it comes to valuation multiples, growth stocks are often overvalued, but if expectations are met, they can lead to big capital gains. When it comes to growth, these stocks do better than their markets and can be great long-term investments. High risks are also linked to growth stocks. This can cause companies to lose a lot of money if they don't meet market growth expectations. Also, some businesses put revenue growth above everything else, which can be bad, especially in the stock market today. In the past few months, investors have moved away from growth stocks and towards value stocks, which are more resistant to monetary tightening and inflationary economic conditions. This has made it more likely that these investments will go down, so investors can buy growth stocks at lower prices. With this, we can say that growth stocks can be a great way to get rich on the stock market and change your life. Of course, it's important to know which growth stocks to buy and when. So here is a list of stocks that I think have a very good chance of growing quickly by 2023. First is Marvell Technology, then Zscaler, Bill.com Holdings, Li Auto, RingCentral, Cloudflare, and Coinbase Global. But keep in mind that stocks are often hard to predict and can drop quickly at any time, so please be very careful. Now, I'll tell you why I think these stocks are good ones to think about. Let's start with the first one. Number 1. Marvell Technology. Marvell Technology makes and sells integrated communications and storage-based circuits for high-speed network equipment, hard disk drives, and consumer electronics. Since the beginning of the year, MRVL stock has dropped 33.72% to $59 per share. This is because the people who owned the growth stock sold it. Still, Marvell just said that cloud data center Ethernet switchboard shipments have more than doubled from one year to the next, and that in Q4 2021, they will have a record high market share of 31%. Even though it hasn't done well, Marvell is expected to grow quickly in the next 2 years because its cloud solutions are still in high demand. Total revenue is expected to rise by 50.3% by 2022 and by 46.7% in 2023. On the other hand, MRVL's bottom line is expected to get worse in 2022 with a net loss of $421 million, before making a strong comeback in 2023 when it will be worth $291 million. As a result of this development, net margins are expected to increase to 4.76% per year, which will raise the price of MRVL stock. The IT company is also very well balanced, with only $444 million in net debt in 2021 and a leverage ratio of 0.48 times. Also, analysts are very optimistic about the growth company. Their average price target for the next 12 months is $91, which means a possible gain of 57%. The company's valuation metrics are stretched with a forward EV of 20% and a price-to-book ratio of 3.2%. Number 2. Zscaler Inc. Zscaler is a cloud security platform with no trust. ZS stock has dropped 29% so far this year to $209 per share. This makes it much easier for investors who want to buy into this fast-growing company to do so. In the past year, the number of phishing attacks on the retail and wholesale industries went up by 400%, according to a report from a cloud specialist that came up earlier this month. These results should help ZS cloud security products, which will help the company keep up its fast top-line growth. In 2021, Zscaler net sales went up by 56% to $673 million, which is a big jump. This year, sales are expected to rise by another 56.3% to $1.05 billion and by 36% to $1.4 billion in 2023. This year's net loss is expected to be $372 million, which is more than last year's net loss of $262 million. Even so, ZS thinks that its EBITDA will rise by 28% to $139 million this year. Also, the company has enough cash to grow. At the end of 2021, it had $589 million in net cash, which is expected to grow by 20% to $710 million in 2022. Analysts on Wall Street have given the growth shares a modest buy rating, with an average target price of $311 per share, which means the stock could go up by 45.41%. But the cloud security stock is expensive, with a 2022 EPB of 49.8x and a projected EV/EBITDA of 202x. Number 3. Bill.com Holdings Incorporated, or BILL. Bill.com is a major cloud-based software provider for small and medium-sized businesses that makes back-office financial operations easier. Even though tech and growth stocks are having a hard time on the market, Bill stock has dropped by more than 20% to $182 per share since the beginning of the year. Market players beat the growing stock because it didn't make enough money. The net loss for Bill was $987 million in 2021, but this year it is expected to be only $308 million. On the other hand, the software company is growing quickly. After going up by 50% to $238 million in 2021, sales are expected to rise by 149% to $594 million in 2022, and by another 35% to $806 million in 2023. Bill.com's balance sheet is also in good shape. This year, the company is expected to have more than $1.03 billion in cash on hand, which will give them a lot of room to grow in the coming years. Insiders recently sold a lot of Bill stock, which shows that the company is priced too high. This isn't surprising given that the company has a high forward EV revenue multiple of 28.4x and a 2022 EPB multiple of 4.65x. Number 4. Li Auto Incorporated. Li Auto is a Chinese company that makes new energy vehicles, and the company focuses on designing, developing, making, and selling smart electric vehicles. So far this year, the company has lost more than 30% of its value and is now worth $22 per share. This is because investors are less interested in Chinese IT companies because of Beijing's crackdown. Even though there are regulatory problems on the horizon, Li Auto has grown quickly in the past few years and is expected to do so again. In 2022, revenues are expected to go up by 93.2% to $7.86 billion. And in 2023, they are expected to go up by 69.2% to $1.3 billion. Even though the company is still losing money and is expected to have a net loss of 691 million Chinese yuan in 2022, analyst predictions show that the things will turn around in 2023, when it will have a net income of 1.52 billion Chinese yuan. If the Chinese EV giant sticks to its plan, the growth stock could skyrocket in 2023, which would be good for the company. Also, Li Auto has enough cash on hand to reach its growth goals with a net cash position of 10.6 billion Chinese yuan at the end of 2021. Even so, Li stock is expensive with a massive forward EV/EBITDA of 282x and a 2022 EPB ratio of 3.74x. This is true even if the stock dropped by more than 30% over the past year. Analysts are optimistic about Li stock and have set a target price of $42 per share, which is a 96.37% increase from where it is now. But hey, we're about halfway through this video, so I'd like you to help me out in some way. Immediately pause this video and please do me a huge favor by clicking like, and if you are new, kindly click subscribe. If you did, you're great, and we really appreciate your help. Rest assured, we'll bring you more videos that will help you thrive wisely. And going back, number 5. RingCentral Incorporated. RingCentral is a global provider of software as a service for cloud communication channels, web conferencing, collaboration, and contact centers. Even since the beginning of the year, RNG stock has dropped 56.44% to $83.82 per share. This puts it to the bottom of our list of growth stocks. Even so, in each of the last 4 quarters, the company has done better than expected in terms of earnings per share and revenue. This shows that this software company is very good at what it does. RNG is going crazy. After going up by 34.7% to $1.59 billion in 2021, sales are expected to go up by 26.1% to $2.01 billion in 2022 and 24.4% to $2.5 billion in the year after that. Still, the company is expected to lose more money in 2022, with a net loss of $437 million compared to a net loss of $376 million in 2021. Also, out of all the growth stocks on our list, RNG has the most debt. Even though RingCentral's net debt was $1.13 billion in 2021 with a leverage ratio of 5.14x, analysts predict that the company's debt will drop by 10.9% to $1 billion this year. A forward EV/EBITDA ratio of 36.5x and a PB ratio of 13.1x show that RNG stock is worth more than it is worth. On the other hand, Wall Street analysts are optimistic about the stock. Their target price is $211 per share, which is up 152% from today's closing price. Number 6. Cloudflare. Cloudflare is a global cloud service company that offers security and software as a service, among other things. This year, the net stock has dropped by 28.19% to $90.59. This is more than the drop in tech stocks as a whole. Cloudflare's top-line growth should stay steady over the next 2 years. This year, net sales are expected to go up by 42.1% to $932 million, and by 32.7% to $1.23 billion in 2023. The bottom line of the cloud service provider should also get better. This year, Net plans to cut its losses from $260 million in 2021 to $189 million. Even so, Cloudflare expects its EBITDA to nearly quadruple to $103 million this year, with an operating margin of 1.39%. By the end of 2021, the company had $663 million in cash on hand. Cloudflare's multiples are still high, with a 2022 EEV revenue of 31.1x and a PB ratio of 40.2x. Even though the net stock isn't expected to grow any money in the next 2 years, experts are very optimistic about the fast-growing stock. The average target for the next 12 months is $153 per share, which is about 69.38% an increase. Number 7. Coinbase Global Incorporated. Coinbase is a financial technology company that provides the cryptocurrency market with end-to-end financial infrastructure and technology. At $122 a share, Coin stock has dropped by more than 50% so far this year, which is more than the combination of cryptocurrency assets and growth stocks. This year, the Bitcoin trading platform is expected to make 7.7% less money, or $7.23 billion. However, in 2023, it is expected to make 19.2% more money, or $8.63 billion. Analysts think that CoinStock will have a net loss of $271 million in 2022, after having a good year in 2021 with a net margin of 46.2% and a net profit of $3.62 billion. This is why its market capitalization dropped so much. Even so, at these prices, CoinStock is a good buy because it is expected to start making money in 2023. Also, Coinbase is well funded with a net cash position of $3.3 billion in 2021, which is expected to grow strongly this year, rising 47.4% year-over-year to $4.88 billion. Analysts also say that the cryptocurrency expert is a moderate buy. Their average target price is $275 per share, which means that the stock should go up by 125% in the next year. In the end, growth investors are interested in how a business or market could grow. There is no way to figure out how much potential something has. Instead, each person has to figure it out for themselves based on objective and subjective factors as well as their own opinion. Growth investors can use certain approaches or criteria as a framework for their research, but they must keep the following in mind: its current position compared to how well it did in the industry and how well it did financially in the past. Well, that's basically the 7 investments that will make a lot of money in 2023. And thank you guys so much for watching today's video. If you enjoyed this, then you will probably learn a lot more from watching this other video. Do these 5 things and never worry about money again. If you click on the screen right now, you can go and watch that. Do you want to learn more on how to thrive wisely? What videos would you want to watch next? Feel free to comment down below. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.